Welcome to our in-depth video on the topic of going long in finance. We'll explain what it means to take a long position, provide detailed examples, and answer common questions with supporting data. So, what does it mean to go long? At its core, going long involves buying a security, such as a stock, bond, or commodity, with the expectation that its price will rise over time. This is a fundamental investment strategy used by individual and institutional investors alike. Let's look at an example. Suppose you buy 100 shares of company ABC at $50 per share. Your expectation is that the price of ABC shares will increase. If the share price rises to $70, you can sell them for a profit. To calculate your profit, you'd use this equation. If you sell the shares at $70, your profit would be $70 to $50, asterisk 100 shares equals $2,000. However, it's crucial to understand the risks. What if the share price of ABC drops to $30 instead? You would incur a loss of $50 to $30, asterisk 100 shares equals $2,000. This highlights the risk associated with going long, the possibility of the price moving against your expectation. In addition to individual stocks, you can also go long on other asset classes such as bonds, commodities, and derivatives. The principle remains the same. Buy low, sell high. Often, investors use technical and fundamental analysis to identify opportunities for going long. Technical analysis involves examining historical price movements and patterns to predict future price behavior. For instance, support and resistance levels in a price chart are commonly used to make buying decisions. Suppose the historical price data for a stock shows a consistent rise after hitting $50. An investor might decide to go long once it reaches this level, anticipating another price increase. Fundamental analysis, on the other hand, involves evaluating a company's financial health, industry conditions, and economic factors. By examining financial statements, growth projections, and competitive positioning, investors can identify potential long opportunities. Now, let's tackle some common questions. First, how do I decide the right time to go long? The timing depends on your analysis and investment strategy. For instance, using a moving average crossover strategy can help identify entry points. When a short-term moving average crosses above a long-term moving average, it can signal a potential uptrend. Consider this data for a 50-day and 200-day moving average of a stock price. When the 50-day MA crosses above the 200-day MA, the trend is considered bullish, signaling an opportunity to go long. Another question is, what is the difference between going long and going short? While going long involves purchasing a security with the expectation of a price increase, going short involves selling a security you don't own, hoping to buy it back later at a lower price. Both strategies have their own risks and rewards. Going short can be profitable in down markets, but it carries the risk of unlimited losses if the price rises instead of falls. In contrast, going long limits potential losses to the amount invested. To summarize, going long is a fundamental investment strategy in which you buy securities anticipating a price rise. It requires careful analysis, risk management, and timing to be successful. Remember to consider both technical and fundamental factors in your decision-making process. Thanks for watching. If you found this information helpful, don't forget to like and subscribe to our channel for more finance tutorials. Feel free to leave any questions in the comments below.